Good afternoon, all. I welcome you to this session, and I would request Neeraj Sharma sir to join us on the dais. Along with, I would request Sukri to assist sir. In the meantime, I'll quickly introduce Neeraj sir. So, sir is a fellow chartered accountant and is a founder and CEO of Provident Advisory Private Limited. Sir has been offering tailored advisory services with respect to strategic growth, governance, and risk management. And sir has been working with GT previously and had led firm real estate practice and has been instrumental in securing major clients. So his entire profile is on the screen, and I'd request sir to please take over the session from here. Thank you. I am so sorry. So before sir starts his deliberation, we need to felicitate sir. So for this, I would request Arun Bhaiya to please come on the dais and offer a memento to sir. I am so sorry for this. Sir, please can you come in? It's okay. So sir is presenting a memento for his gracious time. Thank you so much, Arun Bhaiya. So, sir will be now deliberating on critical aspects related to accounts and audit in real estate sector. Thank you so much.
So I think somebody, very wisely thought of an accounting session while we heard, potential of real estate in the morning, and then, critical areas around RERA and GST. But I'm not sure how much accounting fits in from that perspective. We heard words like radicalization and, GST related areas. But I guess, over the years, when real estate has evolved, even accounting has evolved. And at the end of the day, while it may not become one of the priority areas for, whether it's CFOs or whatever, because it doesn't lead to any cash flow implications like GST or RERA. But I think it does hold some importance as far as compliance is concerned. When I was given this topic, I thought, what should I really cover? Because accounting could really take up a lot of time when you deliberate. And I also was aware that most of the CA fraternity will be here. So I also wanted to spend some time on the auditing areas, right? So what I've really done, identified few areas, which to my mind are critical. When you look at the overall accounting areas for a real estate company, we'll spend some time on revenue recognition, talk about how the groups are structured and how those structures have an implication on accounting and bookkeeping. And then we'll touch upon certain, less important areas, but yes, critical areas. So starting with, revenue recognition, before I, deep dive into what the current, provisions are, let me just give you a quick journey of how revenue recognition has actually evolved over the years. I'll just take back all of you to, couple of decades. When largely, this is pre-2006 era, when the guidance note was issued, the first guidance note was issued. The accounting was more like done on a hybrid basis, right? There were companies who were following, revenue recognition, which were linked to when the properties were actually getting registered or at the final stages, right? There were also companies who were following, which, there was a standard called AS7, which is mostly for contractors, right? But the companies were following AS7 also. Came 2006, and this was a time when, a lot of the real estate companies of the country were thinking of raising capital, right? And, when the regulators realized that there were no specific guidance for companies to really, account for revenues. And, what was seen was a very inconsistent, practices across the sector. And that was the first time that, the attempt was made to come up with a guidance which was applicable for developers, right? It was named as a guidance note for real estate developers, right? Which largely, focused on the concept of risk and reward. I mean, primarily aligned to AS9, right? And when they explained risk and reward, the emphasis was given on the price risk. So the concept was, as long as the price risk is getting transferred from the developer or a builder to the customer, revenue recognition, that is the point that revenue recognition can happen, right? And, typically when you see these projects, these are long-term projects, typically there is a payment plan attached to it. And it was sort of concluded that as long as customers are paying to the developer, right, at each milestone of those payments, price risk is getting transferred, right? Which really meant that revenue recognition can happen over a period of time, right? Linking it to the accounting language, the term percentage of completion method was sort of widely used, which really meant as you construct, you can start recognizing revenue based on those construction activities or the progress made, right? This was 2006. The 2006 where this guidance note was issued. Post that, a lot of private equity happened in this sector, right? This sector actually became a blue-eyed sector at that point in time. A lot of companies got listed. A lot of private equity happened in this sector, and at the same time, after 2008, we saw a lull in the market. There was a huge, crash sort of happened. Post that, it was also discovered that the practices were leading to a different direction, right? You would have heard that point in time, lot of these, regulators and enforcement agencies, identified a lot of players, right, who were doing, operations which are not, considered to be in compliant with law, right? And post lot of these deliberations, I think one of the areas that they identified was that the current accounting regime at that point in time had a lot of discretions, had a lot of loopholes and judgments, right? Where, the developer committee were actually using those open, judgmental areas to their own advantage, right? And, getting into various practices. So, a lot of deliberations happened. I was part of a couple of committees with CREDAI and FICCI. And with a lot of learnings, feedbacks, which went to the regulators. In 2012, Institute again came up with a guidance note, right, which was called revised guidance note, which really, while the underlying concept of percentage of completion method was still, applicable, but they made it more rule-based, right? And all those rules really came from the feedback on the ground, right, which really meant that, so today a developer acquires a land, tomorrow he launches a project, right? What is the stage of approvals? What kind of approvals does the developer have? Whether it's about title, and we heard about approvals around fire, height, environment, etc. Right? The second was around whether the project has been adequately sold or not. Right? So there were the issues around approvals, there were issues around land titles, and the revised guidance note took an attempt to actually address some of those challenges. And we'll see in the subsequent slides how those challenges were sort of addressed in the revised guidance note. In 2017, India moved to a new set of accounting standards which were aligned to IFRS, right? There was a commitment as part of the WTO where it was already delayed, but finally India moved to that, IFRS-based standards with certain carve-outs, right? And you can call it Indianized accounting standard, which were named as Ind AS, right? So with a threshold of turnover, net worth, etc. Companies moved to IFRS based standard, which were called Ind AS. In the first year, uh, there was an exception given to the real estate companies, and it was said that the companies in the sector will continue to apply the revised guidance note, even though for others there was a revenue standard which was there, right? So I think the first year uh, the level of playing activity for companies with Ind AS and other companies was similar, right? But then next year, from 1st April 2018, a new standard came in, Ind AS 115, for revenue recognition uh, contracts with customers. And we will, in the subsequent slides, we will see how that standard actually, if I can use the word radical, it actually created that sort of impact for companies who were following Ind AS. Right? So we'll spend some time on both the scenarios. But first we'll talk about the changes which were made to the revised guidance note, right? So there were four things they really said. The first was that any project should have all the critical approvals in place, right? And they defined certain approvals, environment, building plans, etc., right? So I think that issue of buying land today, launching tomorrow got addressed here. They also benchmarked the stage of completion, right? Which really meant that unless you reach a particular stage of construction, you cannot start revenue recognition. And there was a rebuttable presumption of 25%, excluding land cost, which really meant that, from a developer's perspective also, there has to be a reasonable investment in the project. So if you add land cost there, it could be between 10 to 25%. So the builder is already invested to the extent of 40-50%, which brings a reasonable certainty to the overall project. So it was addressed there. The third was around the project getting sold. Again, they said that the 25% of that project should have been sold, along with a 10% of collection, with an exception of default customers, right? So while everything was very simple to apply, 25%, 10%, 8%, but they did not define default customer. What is a default customer? A customer who is not paid his due, can he become default customer the next day, right? Or, there was no formula, there was nothing. The standard, the guidance note only used the term default customers. And over the period, companies made their own policy with a reasonable, logical theme that, what could be the default customer, and that was explained as part of their accounting policies also, right? But the most important change which they brought was definition of a project, right? And I can tell you, this was one area which led to a lot of, deliberations, discussion between the company, their auditors, their consultants, and even sometimes the regulators, because the definition of a project could really impact the timing, the trigger of revenue recognition. And let me just define it also, which is there in the standard. The guidance note. The guidance note said it is the smallest unit of saleable spaces, which are linked with a common set of amenities with its effective intended use, right? Today, once you see the brochures of all these, developers, you will find, 20, 30 amenities, right? Then how do you define those amenities? And they linked it to the intended effective use. Logically speaking, the intended effective use of a dwelling is, to stay, right? So, a lot of deliberations happened that, in what situations you define a project. real estate also evolved over a period of time, and you started seeing developers launching townships, right? Which, and those townships were not started on day one, right? You could launch two towers, you could launch 5 buildings, and they went into phases, right? So how do you define a project, right? The second scenario could be, and before I say that, the common set of amenities are, basic drainage system, electricity, and then you keep on adding into it, right? Clubs, swimming pool, etc., etc. But I think what is to be remembered is the intended effective use. Can a family live without electricity? No. But can a family live without a swimming pool? I think yes. But again, it is a judgment area. But I just wanted to make this distinction of how the definition of a project could really change things for a developer. If you define a complete township as a project, just imagine those 3-4 conditions, you will only end up complying in 2 to 3 years, which means no revenue for those couple of years, right? The second example is the cluster of buildings. And if you have a common drainage and electricity, which to my mind is a basic amenity when somebody would really need to actually start living in a house, right? Those could be considered as a project. And amongst majority of the cases, this was the view taken, right? But I can tell you, and whatever I'm sharing is all from real examples. I've been, part of the auditing fraternity for, more than a decade. I clearly recall the discussion around swimming pool, right? Which really said that, is it a common amenity, right? And then, see, with judgment areas, there's no wrong or right answer, right? You have to link it with logic and with the surrounding, information that is available. But largely, right, that all the developers ended up defining project with the middle of the example, which is a cluster of buildings. Because either of the cases, in the first case, it will not have suited them, right? In the third case, their auditors or their consultants will not agree, right? So I think this was important. I think rest of the conditions, as I mentioned, were more around application, right? Less of the judgment, as I said. Let's move to, which I said something which radicalized the revenue recognition for real estate companies. All the companies who were to follow Ind AS, right? When this Ind AS 115 came, and I've not quoted the standard here because everybody can refer standard, but I've just put in some important points which are critical, right, to really understand the implication of the standard, right? The standard talked about a 5-point approach in terms of you identify a project, you identify the performance obligations, transaction price, and then how those performance obligations are getting satisfied. So to my mind, 3 things were very, very important, right? Timing of revenue recognition. The standard, the way the literature was, it says the revenue can be recognized over a time, which means percentage of completion method, or at a point in time, which really meant that, towards the end of the project, right? The second thing was the transaction price, right? In Indian GAAP, we were only used to understand whatever consideration comes, that is the consideration for a, selling of a property or goods, right? But when you move to Ind AS, there is a concept of fair value, right? You have to really unbundle that consideration to see that what is actually coming to the developer for selling that, property, right? And the way the transactions are getting structured, the customer, arrangements, customer agreements are getting structured, you will see a subvention scheme getting very, very common, which involves certain financing, arrangement also, element also. The second could be the various, incentives or rebates, which typically a developer gives to customer on various conditions. So if you pay on time, you get a 2%, TPR, they call timely payment rebate, things like that. So all those conditions are, all those elements are actually are potential adjustments to your transaction price, because those are not the fair value of your consideration, right? Which is something different than what we have been used to auditing or bookkeeping. And the third and the most important piece, which really, impacted, is the performance obligation, right? And performance obligation from the perspective of the developer and the buyer. Let's visualize this situation. See, from a perspective of a developer, what is his performance obligation? His performance obligation is to, complete the project, get all the approvals, clean title, and hand over the completed unit to the buyer, right? From a buyer standpoint, it is timely payment over the project. The standard also talked about a concept of customer obtaining control, right? And this really became an area of debate. And obviously with RERA settling in, the customer agreements were threadbare, right? Discussed, and we saw all the, big legal firms issuing opinions on this concept, right? To really say that if the customer is paying to the developer over the life of the project, is he actually taking the control of the project or not, or the unit that he's bought, right? One school of thought was that the customer is now responsible or is now exposed to the price risk, right? If the price goes up, he enjoys the benefit of it, right? The second was the customer can pledge that unit for when he takes a housing loan, right? That underlying property becomes a collateral, right? The argument against was, can the customer really direct the developer to say that, okay, this is my house, and in a 4 BHK, you've given me 3 balconies. Can you add one more balcony to my fourth bedroom, right? Obviously, it can't be done, because there is a standard spec that developer prepares, right, which is then constructed basis that. So that argument of customer directing any change in that unit really became the thumb rule. And most of the developers, I would say, I've heard about couple of exemptions nationally I'm talking about, but most of the developers, all the listed ones, ended up recognizing revenue at a point in time, which really meant for them the life changed from POCM, percentage of completion method, to a CCM, which is completed contract method. And let me just help you to visualize the situation. The second column is where developers or companies who are still following the revised guidance note, they are following percentage of completion method, right? In a simple example of a project value of say 100 crores, assuming everything is uniform, project life cycle of 4 years, every year they account for revenues of 25 crores each, right? Moving on to Ind AS 115, right? Revenue recognition happening at a point in time, right? Which really meant when the performance obligation is getting completed, customer taking the control, which is happening at the end of the project life cycle, which is in the 4th year. Impact on the books: first year no revenue, second year no revenue, third year no revenue, 4th year revenue of 100 crores. And the line at the bottom of the slide, I don't know if you are able to read it, it says that Ind AS 115 causes revenue deferral amongst major real estate developers. This is the headline of the quarterly results of April 2018, April to June. So this is the newspaper headline, right? That's the impact those developers had on their books, right? So again, just to recap, companies who are following Ind AS or developers who are following Ind AS, they have to follow completed contract method. Companies who are not under Ind AS regime, they have to follow percentage of completion method. And the life in both the projects is complete North Pole and South Pole, as we can see. I'm not getting into the complexity of income tax here, because when this happened, you can imagine what would have happened to the income tax computations, because assuming a project which is ongoing, and in the third year this happens, so they had to de-recognize the revenues of last 3 years, profit of last 3 years through the opening adjustment, and then their fight with income tax department started, because the department failed to recognize, because it was not suiting them also. They were used to get, advanced tax on a regular basis. But having said that, most of the companies have crossed this bridge now, because in next 2-3 years, they created the pipeline of the projects so that every year you have one of the projects getting completed and then you have revenues, right? The other topic I wanted to touch upon was around the structures of the group, how real estate companies or how real estate groups are concerned, right, are sort of organized. While partnership firms and interest in joint ventures are reasonably simple, because you account for your own share based on the percentage holding, right? JDAs have been the flavor of the day, right? And we'll spend some time on that. And then I also want to touch upon land owning companies, right, which is still applicable in West Bengal because of the Urban Sealing Act, but largely it is impacting all the larger groups. So JDAs, in a very simple sense, I think all of us understand 3 scenarios. You take development right, you pay for it. I think it happens very rarely now. Nobody pays directly at upfront. The other 2 scenarios are applicable, which is you pay either through revenue share, or you pay either through through some constructed units in the project. In accounting terms, this is known as a barter transaction, right? Because there's no exchange of money, right? There's exchange against land. You are giving, either share of revenues or the area, right? So from a guidance perspective, there are 2-3 things. One is, do you really account for, how much do you account for? Because one portion belongs to a landowner, right? Which could be 10%, 20%, depending on how the deal is structured, right? The second is, what value should you take for that land? Because you're not paying upfront, right? And the third is the timing, right? Timing is slightly easier. But from other 2, matters perspective, the first, the one is, for the guidance around barter transaction, it's said that this has to be accounted for on a gross basis, which really means that the developer will account for the entire project, even if 10%, 20%, 50% belongs to the landowner, right? So both sides of the balance sheet to an extent gets inflated, right? And at what value, right? So again, Ind AS, and even if it is not Ind AS, even the guidance note talked about the concept of fair value, right? To really say that it could be the market value of that land or the construction selling price of the unit that you are selling. Those could be assumed as fair value, right? There could be a third scenario also, but typically these 2 values are available, right, when the transactions are happening, right? So those are assumed to be the value of that land portion, and accounting is grossed up, right? And we just talked about revenue recognition for Ind AS companies. It will be done at a point in time, which means at the end of the year, at the end of the project, when the project is ending. For JDA, it's slightly a different scenario, because your performance obligation is towards the landowner, right? which means, and the landowner, we discussed about the control concept. Landowner is still the owner of the land. So that means he still has that control. He's only transferred the development rights to you. So from a JDA perspective, accounting has to be done basis the percentage of completion method as per the JDA, period, etc. terms that you have said, right? So the nature of accounting, the value that needs to be taken, and the third is when do you actually trigger the accounting of revenue. Because it could happen that today you do a JDA, but the project getting launched in the next year, right? Logically, because if you look at the percentage of completion method, right, it will only start, triggering when the launch happens. And that's the logic was taken for this accounting also, because before that nothing will happen on that piece of land. So when the project launch happens, that is the date you start doing the percentage of completion method for the JDA accounting. So this is on the JDAs. The third thing I wanted to cover was so there are different words which are being used for these companies. I've taken a very simplest form, which is the land owning companies. So typically you will find large groups, right? They incorporate a lot of these companies for the perspective of acquiring land, right? Within their for their construction purposes, right? But there are different kind of accounting being followed, right? And I'll tell you the very characteristics of these entities. One would be around shareholding pattern. So you will find either no holding, right, or a very negligible holding of these companies. The business rationale and practices will be very, very restrictive. So it will be written that these companies are only incorporated for acquiring land, right? Funding will happen either through advances or debts over a period of time. These companies, while these companies are acquiring land, but per se these companies are insulated because the land is being acquired on behalf of the other companies, right? And that's how these getting insulated from the risk of land prices going up and down. And lastly, with very, very marginal return, I would say no return. Typically, they work with the cost plus model, reimbursements of cost and very marginal returns to them. Right? Ind AS goes with the concept of a control route, whether you have a shareholding or how much shareholding you have, right? Who is controlling those entities from a perspective of economic interest, right? Because obviously these companies are doing some operations, and there were different practices which were being done by various groups. Some groups were consolidating these entities as subsidiaries, and some groups were not doing anything. They were just shown as companies which are outside the perspective of the group, right? And obviously, other than the accounting, there is the implication of disclosure also, right? Are these related parties or not, right? Even if you say that these are not, I'm not holding anything in these companies, or my holding is only 5%, but then who's holding those companies? Are these promoter group companies or not? So those implications come into discussion, and you see different practices being followed by different companies. But I just wanted to introduce this concept, which is called SPEs, special purpose entities. We have heard the word of SPVs, right? Entities created for a particular project, SPVs, special purpose vehicles. But from an accounting standpoint, these are called SPEs, where you have to really identify and demonstrate who controls these entities, right? And the couple of bullets here will give you, when you start looking at these entities, will give you an indication, right? Who's actually benefiting with the entire operations of these entities, right? So one has to look at these attributes and then find the linkage. To me, if a company is under Ind AS, if they're following Ind AS, it is very difficult for them not to consolidate these entities, because they will eventually come under the definition of control, right? But again, something which is very, very unique to this sector, uh, and we have seen different practices there. But to my mind, ideally these should be consolidated as subsidiaries, because these are being controlled there. Some quick concepts. Again, I have only kept topics here which have invited a lot of discussions, deliberations during the process. The one is around provisions and contingencies, right? And there could be 2-3 areas where the challenges really comes. With RERA finally setting in, it also establishes around how much compensation needs to be given to a home buyer, right, when the non-compliance happens or project gets delayed or whatever. Having said that, I'm not going into the complexity of whose delay was it, government approvals, developers' own delay, etc., etc. But I think this poses a big question when the project gets delayed. How much provision one needs to book? There's no right answer to it. It's a judgmental area, but one has to look at the RERA provisions and also the underlying issues of the project delays, etc. There could be other customer litigations. So today, with all that customer activism at the highest level, right? With a very small thing happening, people go on social media and start their own processes of litigation, right? How do you manage that, right? And I'm not saying this is only about social media, but litigations in consumer courts, high courts, etc., right? The third thing, which is again with the onset of RERA, is the defect liability period, right? So before RERA, once you give the possession to a customer, you are out. You are just maintaining the property, but then it also gets transferred to the society members, etc. But RERA talks about a 5-year post-defect liability period. I mean, to me, which is 5 years is a huge period, right? How do you account for that? Because typically, I don't think whatever project you make, you will end up having some challenges in those projects. So again, judgmental areas, but it's very difficult that there's no provision around some of these things in the books currently. There will be project delays, there will be customer litigations and contingency around DPL, right? Borrowing cost, again, a very hot topic for discussion. While the definition is very simple and the accounting prescribed is very simple, any cost relating to a qualifying asset needs to be added to the cost of that asset. But just giving you 2 scenarios which are very peculiar to real estate companies. A land bought today, but for future development, you may not do anything with that land parcel for say for first 2-3 years, and obviously there are debts in the company, right? Does this qualify as a item from a borrowing cost perspective? Anybody? Yes or no? Every developer, for them, it's a simple thing, right? They will buy land and then they will keep it. At the right time, they will use it for projects. Should this get qualified for a borrowing cost capitalization? Any views? Yes or no? So there's no wrong or right answer. It's all judgment. No. Okay. Why do you say no?
Because we have not started construction, so
Okay.
there's no, if you need qualifying assets, so again there are interruptions in between and you need to stop the capitalization.
Okay. So let's tweak it with the second bullet. The similar scenario, but then some work is being done by the developer. Does anything change there? Anybody else?
Land is in the SPV, then whatever the cost has been incurred for the
So let's not get into that complexity of SPV. Just imagine that land is in the main company, you have debt also, you have borrowing, you have interest cost, and you have this scenario. Should you capitalize interest on the second scenario? Yes, how many yes? So business, in the first one also you're putting into business, right? Because for a developer, land is the raw material, right? Just imagine any company, they first buy the raw material, they process it, and then they sell it, right? For developers also, he's doing the same thing, right? I think the only distinction which is being made here that in the second, let me talk about the second one. And the second one, logically, should the interest should get capitalized, because when you buy land, there are, I'm sure 100 things the developer needs to do with that land, right? Marking and, clearing it and other regulatory pieces also, right? To really say that you are not actually doing the construction and hence no borrowing cost, to me is being not fair to the developer, right? So in the second case, largely people or rather auditors or regulators have allowed, right? First one is still a debatable issue. I have seen fights in the first case also, because developers, see, I'll tell you developers' perspective, right? And again, there is a strategic business reason to it. They will say, today I'm buying a land, right? I will wait for the right opportunity when the market conditions are in my favor. Land, projects are coming up. My region is growing. I will wait and then launch the project at that point in time. I don't think there's anything wrong in that, right? But sometimes accounting gets delinked with the business rationale, and this is one scenario where you end up with a different accounting, right? The third piece is around the brokerage contracts, right? Today, how the real estate sales happens, right? It happens through brokers, the channel partners, and you will see a lot of big companies have entered into that business, right? Anarocks of the world, and these are very, very big companies, right? And their terms of contracts are very, very different. It is not as simple as that, you sell a project and take a 2% commission. It doesn't work like that. The terms are so fancy, they are linked to the level of, sales value you achieve, not even number, sales value you achieve, and they are given, sometimes given discretion also in the pricing, right? So it is very important especially with Ind AS, where your revenues are getting deferred, say for next 4 years, right? Or 3 years, whatever, as per your project life cycle. But you will still have these expenses coming up, because from an accrual, point of view, when the services are being rendered, you have to accrue for the cost, right? The only challenge there is that, sometimes people talk about this revenue cost matching concept, right? This is the revenue and this is the cost. It has to match. But again, to my mind, accrual is a more fundamental concept. Even if you have no revenue from say, you are selling a project A. Project A will only have revenues in the 4th year, right? But your liability to brokers has arisen because the broker has done their services. So to my mind, those brokerage costs will have to be accrued, irrespective whether revenue happens 2nd year, 3rd year, 4th year, right? So I thought there was, again, mixed practices being seen on accounting for brokerage, right? So I thought, let me just talk about this. So, moving from accounting, I thought let's also spend some time from an auditing standpoint, right? With the lens of the auditor, what could be the potential areas one needs to focus, right? And I've just taken 3 buckets. The first is really around the audit planning, right? Again, it goes without saying that the time spent in planning and understanding the entire, process, business, group structure is very, very critical at the start of the engagement, right? Group structures we talked about, very important because it could really impact the accounting and the disclosure, right? And how some of those, group structure, whether those are JDAs, whether those are, incorporation of land owning companies and even maintenance companies, and there are, how these are getting accounted with the concept of control is very, very important, right? In any real estate company, you will find a very significant line item of in the balance sheet of advances, right? Advances for land procurement, right? And there will be a, the aging element of this will be very, very high, right? So that really becomes something which gives discomfort to a lot of consultants, regulators, and the auditors, right? It is very, very critical to understand and go through the underlying evidences of these land procurement transactions, because I mean there could be issues around money getting diverted to other businesses or things like that. The third is around cost and sale price movements, right? How the cost per square feet is getting changed from initiation to the end of the project life cycle, right? Because today, when you launch a project, you create a broad project estimate, and with RERA, etc., you have to transparently, talk, or rather file those, statutory filings with RERA authorities, which contains some of these things, right? And again, sale price movements, right? Today we have the benefit of a lot of things which are available in the public domain, right? So I think it's very important to corroborate what is happening with a company A with the industry trend. And mind you, industry trend you benchmark only with the local market. Real estate is a very, very local business. You can't compare what is happening in MMR to say to NCR or say to Calcutta, right? All the markets are behaving differently, right? So when you are actually looking at the benchmarking, you have to do it with that understanding, what are you comparing with? Otherwise, you will get a very different picture, and which will only confuse you, right? Lastly, litigations, as I said, I think litigations, the completeness and valuation of litigations becomes very, very, very critical, right? I won't spend much on the RERA compliances. We had a very wonderful session with Vinay this afternoon, but I think the only thing I will say that these regulatory mechanisms are only helping us to give us the additional information, right? Which the developer is actually filing with the regulatory authorities, right? It actually starts with when you register a project, where you commit a lot of things, cost, timelines, etc., right? Which gives, again, some information to the consultants, auditors, etc. The other is the RERA account, the 70/30 account that we heard about. Very important to really see the reconciliation of that account, right? I mean, the compliance is very simple. 70% of that collection money has to go towards construction of that project, whether it is going or not. Yes, there are regular certificates which goes to the authorities, but sometimes we know how people are issuing those certificates or not, right? The third is the other filings, right? So at least in a couple of states, I have seen a very detailed annual accounts being filed with the authorities, at least in, I think, Maharera and even in Haryana, I've seen that. I think that those detailed filings will give you the complete, in a very transparent way, the details of the project, which obviously need to be reconciled with the books. Again, very supporting information data points for the auditors, right? Lastly, I just wanted to link the contingent liability and the going concern piece, right? We heard about provisions, we heard about, wherever contingencies could happen, right? One has to be very careful to look at the complete picture, right? So the liabilities could be around incomplete projects, and those could be huge because they could be, a lot of dues payable to the government or related authorities, and also the cost side of the projects to vendors, liquidated damages, etc., right? The second is again a big ticket item is the customer related liabilities, right? If one theoretically adds those, the number could be huge. And the third, uh, the JDAs, right? While when the when the JDAs are successful, I think everything is hunky dory, everything is fine. But imagine a JDA getting into a dispute, right? Because the underlying uh, theme of every JDA is a land, right? So just imagine if the dispute happens on that, the liability could run into huge amounts of crores, right? So that's all I had, given the time I had to uh, pick up certain key themes. But happy to have any questions or any thoughts anybody has, right? I was told that I need to be a little fast. I don't know how did I, right? But I tried my best. Happy to have any thoughts, any comments, anything from anyone. I know it's a third technical session, right? It's quite heavy for everyone, but yeah. So Vinay, let me tell you, I'm not a RERA expert, so just
No, I'm just considering in terms of the accounting because you mentioned that this is a very different industry in terms of everything, not only in terms of the taxation, even for the accounting also. So how the regulators like the corporate affairs or anybody who is looking in serious about these numbers, how do they um, reconcile, how do they come out with? Because absolutely there is no way that anybody can reconcile these numbers with any other stage, either the GST or a income tax or a rare or anywhere. Like whatever we declare, we declared.
so let me give you the perspective here. When RERA came into being, right? I would say the first year or so, people took time to understand the implications, right? But given the seriousness, right, with which RERA came into being, and obviously the implications of not complying with RERA, right, was very serious, and somehow while it is also one more layer of compliances on the companies, but I would say there was no option. To me, giving numbers in RERA without reconciling is a suicidal for any company, right? If any company is doing it, they should stop this practice immediately. At least uh, after a couple of years, there were people created those roles in the organization, right? And all the numbers, right? GST. So see, the implications in all these regulations are severe, right? I don't think anybody can take GST lightly, right? I think accounting comes at the bottom, I would say. But at the end of the day, the entire group is responsible for compliance, right? I think over a period, this fraternity has understood the penalty or implication of non-compliances. With 6-7 years of RERA now, right? I would say that things have stabilized, right? Most of the companies have started using tools which are integrated to their financial systems, so that they have only one truth of data, right, which goes to any other authority, right? So if I was able to answer your question, yeah.
Neeraj, you very rightly said, or rather you made an observation that accounts is at the bottom in the hierarchy. Let me share with you that is at the top. GST authorities day in and day out are issuing notices giving that your PL turnover is this much, GST turnover is this much. On the difference you pay GST at the rate of 18%. So that is how the department, the authorities are working,
So that
functioning.
means GST was on the top, right?
Accounts is at the top. So
No,
now
so-
the point is
okay.
a very
No, no, I'll
important,
just-
a very
yeah, please.
important point comes from here is, like you made a very important observation in some 2 or 3 slides back, that various regulatory requirements or tax compliance requirements ask you to give various data to the authorities. So through RERA, at different stages, to GST authorities, to income tax authorities, through tax audit reports, and then in your balance sheet, etc., whatever. And in balance sheet also, figures or information are scattered in places. So what has been your experience on, like I gave you that example of PL turnover versus GST turnover. So similarly, that reconciliation issue I am actually coming on, that figures in balance sheet, figures in RERA, figures in GST, figures in income tax. On these reconciliation issues, this kind of notices like GST, similar kind of notices or similar kind of implications or warranting some further investigations, say by the Ministry of Corporate Affairs, as Vinay was trying to tell probably. So what has been your experience on that? To what extent industry is actually prepared with that or compliant to that?
I would say
In
that I think some portion I gave in the first one also. I think industry has realized the seriousness of these, whether there are multiple regulations or not. I must also say that I sympathize with the industry because we are talking about ease of doing business, but the layer of compliances is getting one after the other, right? Just imagine a scenario where you could just file one thing with one department and then it goes to others, right? It's a pain for the companies, but I can tell you there is a thorough reconciliation which happens, right? And I was giving one example. There's a annual accounts which gets filed in RERA, right? In that annual account, there is a clause of reconciliation also. It says that this is your RERA number, you filed in the RERA. This is the number in your books of accounts. So eventually, if you are not thorough with your reconciliation, you can't find that annual account. So by default, right, reconciliations are happening. It's a pain, it's a cost for the companies, right? But I think for the profession, it's more work also. So I think it gets balanced there. But I can tell you, people are not taking it lightly. People are not taking it lightly. At least I've been, part of a lot of large real estate companies for more than 10 decades. I've signed a lot of these balance sheets, very large ones in India. I think the consciousness of compliance is very much there. And I think day in, day out, we keep on also hearing the results of the companies who are not complying. So I think that awareness is really settling in, right? Thank you.
Hello. Yes, sir, I have a question.
Yes, sir.
Sir, you talked about guidance not on real estate. And you suggested that until unless one follows Ind AS, one should follow percentage of completion method. So does it not hold good, sir, if we follow project completion method following AS 9 of revenue recognition?
Okay, so let me just correct if I said that. For companies who are required to follow Ind AS, right, they have to follow completed contract method. So it's not an option, right? Yes. They will follow completed contract method. Yes. If you are not in that threshold of Ind AS, yes, you are other companies, yes, then you have to follow the guidance note percentage of completion method. So you are either here or there. So it's not a choice, it's not an option.
Sir, the guidance note is the optional, sir. Don't you think, sir? But because accounting standard is compulsory for every company to follow.
So I'll tell you, it's a huge debate which happened many years back, right? But look at the history of real estate accounting. The first guidance note came in 2006. After that, the new other guidance note came in 2012, right? In 2008, right? I'll tell you one live case where we were the auditors, right? And that company challenged us. That guidance note is not, it is a guidance note, it is not an accounting standard. But the authority of guidance note is, if the company doesn't follow guidance note, auditor has the right to qualify. So that, I hope that answers your question.
Okay, thank you.
Thank you so much, Neeraj sir, for discussing and sharing your insights related to accounting and audit of real estate sector. I would now invite Sukrit, my friend, to offer a formal vote of thanks. Thank you.
Very good evening to everyone. Now, we had a very good discussion about the critical aspects relating to accounts and audit, especially towards the last, where we had a healthy discussion that which profession is coming into top, or which segment is coming into top, whether it's accounts or tax. I would like to extend my heartfelt gratitude to Neeraj sir for investing his time and sharing his valuable insights on this critical topic. In my humble opinion, while navigating the complexities that we face in direct taxes and indirect taxes, we undermine the importance that accounts hold. Through accounts, the accounts give birth to the data, and through which we are doing the filings, whether be it GST, RERA, or income tax. And as Neeraj sir has rightly said, that it is very important to reconcile all of those things. Thank you everyone for your patience, learning and hearing. With this, we are moving to our last session, that is in the form of panel discussion on joint development agreement. I would like to call Shubham Khaitan Bhaiya to come forward and carry the session forward. Thank you.
Thank you for inviting me, and I thoroughly enjoyed sharing my views. So thank you.